Today we're going to be talking about the timing window with our 50 pips a day forex trading system. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke. Welcome back. It's 2021. Today we're going to be getting started again. I hope everybody's had a great break. We've had a couple of really great weeks in the markets. I know a lot of traders asked earlier on people have told them don't trade in December. As I said, I traded right through, normally through December outside of the major public holidays. There was fantastic opportunities each and every day. The markets traded as they normally would, which just gives more credence to the fact that they are probably electronically market maker driven, and the volume stayed fairly consistent. Obviously, outside of certain hours, the volumes may have dropped off in some instruments, but there was plenty of opportunities for traders to take well more than 50 pips a day, especially in gold. Now, just to highlight this, I have only been trading gold, and at this stage will probably only continue to trade gold. I was following the pound as well, but I've mainly only traded gold in the last 8 weeks, and I will probably only continue to focus mainly on gold. The reason why that is because it moves each and every session. I'm going to talk a little bit more in the coming few videos about how I trade the open each day on gold for a minimum of 25 pips right off the open, which those trades are typically over within 15 minutes or less. They're very fast, they're quick, and they're great opportunities for traders with just, again, tight stops and simple trading setups, all based on coming back to where the money is. We're going to review the process. We're going to talk about the timing window. We're going to just focus on the simple steps. I'm going to try and cut these videos a little bit shorter and spend more time on the charts. And again, thanks for a ton of great feedback. Hope everybody had a great holiday season, whatever you celebrate, wherever you're at in the world. And again, to my colleagues over in the US who are following the World Junior Ice Hockey Championships, I know we're all hoping that we get a Canada-US final. Congratulations to the other countries. But an amazing tournament. The World Junior Ice Hockey Tournament is truly one of the best sporting events every year on the calendar at Christmas and New Year's Eve. Coming back to our timing windows: 8 to 11 p.m. for Asia, 2 to 5 a.m. for Europe and London, 8 to 11 a.m. for New York, and those times are New York Eastern Standard Time. I know that traders ask, why don't you use MT4 time, TradingView time, whatever time? I don't know. I'm just going to say this. Those are the times I use in New York. My time zone in Perth is the same as New York, other than daylight saving time, where New York goes back an hour, the US goes back 1 hour. But this is the timing window for when these markets will move. Today we're going to talk about the gap times, we're going to talk about the pre-market, and we're going to talk about the variations inside of each of these 3-hour blocks. So in the pre-market, the market typically will establish a high and low unless we've come out of the US session in a creeping format or they've reversed. And again, we want to look at who is in the money, who's already in the money, where the high and the low have stops. But we also want to know who is in profit. Who is in profit? So typically, nobody gets a free lunch, and the market will allow traders to get into profitable trades. And I talk about presetting your profit targets, whether that be 25, 50, 100 pips. Pre-programming those in and taking the money off the table, learning to take a profit, because you can be in tremendously profitable trades and these markets will blow you away how fast they will come back or slowly come back against you, getting you to second guess about whether you should get in, get out, take profits. And if you've been up the money and you don't want to give that back, you're holding on hoping that it reverses. All these little scenarios. Go into each trade with a plan, knowing that you're going to take something off the table. 25 pips on the opens each session adds up quickly, especially if you're scaling those up in size. If you're taking 50 pips later on off the high or the low of the day in a session, whether that be London, New York, and in Asia some cases, those could be trend trades. Again, the markets do three things. They break out, they pull back, and they trend. they break out, they pull back, and they reverse, false break reversals, and typically move to the other side of that trading range. And then we have a breakout pullback and markets that stay range bound, just trading sideways. I am focused at the high and the low of the day, always, because that's where the money is. That's where stops are. That's where retail traders' stops are. That's where other time frame traders will be entering into the markets, whether they are breakout traders, 1 hour traders, 4 hour traders, end of day traders, especially if we are at the high or low of a week or day. High and low of the session will typically attract breakout traders and other traders looking to counter trend those trades in sessions. So again, for example, New York may be looking for a reversal trade, or they may be looking to continue a trend, but they will stop hunt into profitable traders who are already in the money, to either stop them out at break even or with a loss. If they're caught in the wrong direction, selling down low and it's a reversal, they could be looking at 50, 100, 150 pip move against their trade. So again, very critical to take your loss when you are stopped out. High and low of the day. It is all about the money. You're trading against the smart money, the electronic market maker, the algorithm, the high frequency traders, whatever you want to call them. And the only way that they make money, or that you make money, is if they take money from your account into theirs. So the way they do that is by hitting the stops, stopping out traders, going against big moves where traders are caught chasing a move that's trending on the third level, or they're caught chasing a move after it's moved in a strong trend. All the indicators drag traders, keep trading in that wrong direction. The next session opens up and it takes them further into the extreme, back to the high. Engulfments and pin hammers. 1 bar stops, 25 to 50 or more, depending on where we are at in that 24-hour cycle. We could have Asia, London, New York. New York could be planning a reversal. We could have Asia, London, and New York reversing and taking out Asia. All those different scenarios. So important to understand the timing window, because that's the most important part. The pre-market will often give us a peak formation, high and low. It may be a stop hunt into the previous US session or previous day, a profitable trade in the pre-market 2-hour window. Gold trades an hour later than the other pairs. But when that 3-hour window opens in Asia, typically we will often get a move at the open of the session that will either be a stop hunt for a hitting the high or hitting the low, stop hunting either into profitable trades or at the high and low of the day before locking that in, or as we saw today, we can get a breakout pullback and a continuation. Now often Asia, especially Monday, Tuesday, Wednesday, we can get a peak formation, high or low, for the week. So again today, as they've extended it out well over 100 pips, we could be in a trending day. So I would expect possibly in the gap time that stop hunt could come back into the trend. Now we can get some scenarios in the gap time. I've talked about not trading the gap time except in certain situations. Those situations are when the market goes to the high or the low again in that gap time. So we can get a peak formation, the market pulls back inside, and in that second or third hour in the gap time it hits the highs. We could get a peak formation for the high of the week or a low of the week reversal. We'll see this often in the gap time between New York. We'll talk about that in a second. But often if the market pulls back inside, this move may not be over, which means again at the beginning of our next 12 candle window, we will see a move in that open back towards the high or low of the day, hitting stops on traders that have counter trended the move off the high or the low to continue that trend, and they may put a peak formation in that London hour. So again, we could get an extension of that range. Again, from the numbers, we may be moving in 25 or 50 or 100 pip box increments, especially on gold. Pound probably not quite as big, but we've had some very big ranging days. The pound will follow this scenario the same. These are electronically market maker driven markets. So we'll see a stop hunt, trap, and a trade in most cases. So that stop hunt could be back into the trend and then a continuation. That stop hunt into the trend can trap traders in the wrong direction, or we can see the market working the high or the low, trapping traders in the wrong direction before engulfing it, locking it in with a pin hammer and reversing the market. But again, we're looking for a move back to the higher low of the day, unless they've already locked that in, and then we're looking for the trend trade either back in the other direction or the continuation. But when we get to this middle 12 candle window, we want to ask ourselves, are we at the high or low of the day, or are we inside? So Friday was a great example. London started off at the low of the day, just in that last 30 minutes before the session began. They locked in the low of for that day. It was a W formation, and as they went into the open of the 12 candle window, we were off the low of the day, but London largely traded inside of the high and low of the day. So again, the gap times, I want to focus on peak formations that form either to the high or low of the day. So again, a stop hunt in that gap time hour. So working at the extremes, looking for where is the money, who is in the money, who's the first mouse, who's the second mouse, do they put a peak formation inside. Then we head into the next gap time. We're going to see a stop hunt typically in this last hour prior to each session. So in that last 30-minute window prior to the next 12 candle window, we will often see them lock in one of the extremes if they've gone outside of that range. We go into our next gap time. Have they pulled it back inside now? So again, remembering, if you're not at the high or low of the day, you're inside. So I know a lot of traders, you've got a lot of indicators and everything on your chart, and I mark off on my 15-minute charts the high and the low of the day. That's it. Then if I'm not near those levels when the sessions begin, and if they haven't gone outside of those in the gap times, then I know that we don't want to be trading on the inside, because at some point as we head into the next window, they are going to hit the stops and either reverse the market, or they're going to break out in the gap time and continue that move in the next 12 candle window. So again, New York, we're going to stop hunt to one of the extremes and either hit the stops and reverse for a reversal trade, or it's a stop hunt back inside a 1, 2, 3 for a continuation measured move. And typically that equities hour will be in New York especially, and the London hour, the middle hour, will typically be a move into the wrong direction for that stop hunt back to the extreme, but also getting traders to chase that momentum back with that trend, and they get caught either up high or down low before the market locks it in. And often in gold, that market can come back 100 or 150 pips in that New York reversal. So very important to understand that. We're going to look at the charts from last week. Again, fantastic opportunities in gold. For those traders who want to look at the other pairs, again, we can review some different pairs, but I am only trading gold at this time. So hopefully you got some value out of today's video. We're going to have some tremendous opportunities coming in this next couple months, as every market will have an initial balance in the January-February time frame for the year. Often that first couple of months sets a high or a low, as we see in that initial balance, even on our daily charts, our hourly charts for the week. That will often give us a lot of information about where these markets may be heading as we head into the new year. So welcome back. Stay disciplined, stay focused. Come back, it's a new year, tons of opportunities ahead of us. Have a great trading session, and may the markets go with you.
Welcome back, traders. 2021, we're going to review the Christmas week on gold. And again, just specifically on this video, we'll be just targeting our normal 15-minute, 50 pips a day, high and low of the day, round numbers, engulfments, pin hammers, 12 candle window. Keeping it simple and straightforward, nothing complicated. And understanding if you miss a trade, or if you come to the screen and the market has already moved and you can't find an opportunity, understand that Number one, if you are to enter the market, you want to stay in line with the trade that is already in place, but also knowing that when you come back in that 12 candle window into the next session, unless you've taken a trade in the gap time, which again, the Monday prior to Christmas was a great example of a peak formation in both gap times. And again, keeping things simple, looking at the closes of each session, understanding that the markets are doing one of three things. They're either in a trading range, they're going to break out and reverse and pull back for a false break reversal, or they're going to break out and they're going to trend. So keeping it simple. And then again, just understanding that if a market is in one of those three phases, that you want to be positioning yourself either with the trend, or if there's a reversal or an engulfment already in place, trading in line with that trade back to the other side. If you're in a trading range, understanding that you could be in a squeeze or you're in between round numbers. And again, when the market pushes into a level three times and engulfs into the next day's session, continues to move, breaks through a 50 pip box, and heads in that direction prior to the market opening, we want to be trading in line with that momentum. So looking at the Monday prior to Christmas, we saw the U.S. session, the Friday session, trade inside. It was an inside bar from the previous Thursday. The market gave a high and low in Asia in a 50 pip box and then worked down in three pushes to form a squeeze, going 1/4 below the round numbers before the engulfment in the gap time. So again, an example of where the squeeze happened over 3 hours in the Europe-London window, engulfed in the gap time for a 75 pip move back up through the high of the day before consolidating, working the high, and then in the equities hour reversing in that second candle, coming back to come after traders who are in a profitable trade. So again, learning to take money off the table. You know, whether you took 25, 50, 100 is irrelevant, just making sure you're taking something off the table and learning from every trade. So we see the market opened up on a bit of a gap inside that 50 pip box on top of the round numbers after the engulfment. We were in a 100 pip trading range. The market moved very aggressively and then broke through. We'll talk more about these different opportunities where we get strong candles and then a small consolidation candle. Opportunities where you can position yourself with a 1-bar stop in a strong momentum breakout. But that market continued to move up in the Asian session before consolidating, layering on 50, and then extending back through in the gap time for another 100 pips up, and then reversing with our 2-bar reversal engulfment off of 50, pushing just above the 50 into that upper quarter. Again, an example of an extended stop hunt. And then the market reversed just prior to our 12 candle window in the Europe-London session. So a breakout pullback just above the round numbers. Again, a 25 pip pullback, 50 from bottom to top before the market resumed its downward drive. And then we see a 400 pip move plus back down into traders who were long off, possibly off the Fed on the previous Wednesday night. But a massive stop hunt down before pulling back, and again a peak formation in both gap times, an example of high of the week, low of the week, Monday, Tuesday type scenarios. And then again, understanding that one of these peak formations may actually hold. So if we're trading in line with that peak formation, we want to be watching the price action in the coming days to observe how it handles these price levels where the market has formed its peak formation high and low. The next day, the market again creeper down in the U.S. session before stop hunting up, and then 3 pushes down into the open of Asia, and a stop hunt to the high of the day right off the bat. 50 pip move from that first bar, false session at the beginning of the Asian session for a 50 pip stop hunt back up to the high of not only the day but the previous U.S. session swing highs. Again, who is in the money? First mouse gets in early. They put pressure on him. So this trader might have got in right at the rollover, thinking they're going right back up. The first mouse gets heat or even stopped out. The second mouse gets the cheese. 3 pushes up above double zeros before rolling over and engulfing in the gap time. Again, an example of a move in the gap time. So again, the market is moving down as we head into our 12 candle window. 1 push, 2 pushes, and a 1, 2, 3 right into the beginning of the session. 25 pips below the double zeros before consolidating in our first hour, and a bullpen hammer in the first candle of our equities hour. So again, traders who may be in the money, we want to look at who's in the money. Somebody shorted the bull candle in a big down move. Somebody shorted the engulfment at the double zeros. These traders are in the money. These are always the questions you need to be asking yourself, because as that market trades and then goes into consolidation, pulls back above the double zeros, we want to be buying low if that market is going back up. Buying low in an up move. The market pulls back, we get an engulfment of the low bear, but we also have a pin hammer right at the bottom at the London equities hour, pulling back inside of the 0050 pip box. The market comes back down in 3 pushes and then engulfs at the open of the 12 candle window for a 50 pip move back, getting traders who are in the money. They get a 2-bar, exact same scenario, the 2-bar peak formation. So again, similar to what we saw in the gap time, the 2-bar reversal off double zeros, you trade the break of the candle. So it doesn't mean you're getting in on the 2 bars. You're trading the break of that candle back down against traders who are long off the beginning of this session. Timings. So we have 1 hour. We're into the 3rd candle when that breaks the low of the bear candle of our equities hour. First candle takes traders, hits stops, but takes traders chasing the momentum, thinking it's going back right up through the high of the day. The next candle, if you buy this candle, you're buying high. The next candle consolidates, doesn't completely reverse or engulf, but the break of that 2-bar reversal off the quarter level after coming off of double zeros is a very strong opportunity. And again, you're looking at a 1-bar stop. It's an inside bar after the first bar of the equities hour. And that market goes over 100 pips back down, whether you took 25, 50, went to break even. Again, there was no break of a lower structure, but traders may have been shaken out by the pin in the beginning of that 3rd hour before it consolidated and continued its move back down for another 100 pips. But again, watching it into the close, we see 1 push, 2 pushes, 3 pushes into the round numbers, creeping trend down. Creeping trends end in one of 2 ways. They either blow off in the direction of the trend, or they form a squeeze formation for a reversal stop hunt, or blowing off back in the reversal direction for a squeeze trade. The market formed a W on its 3rd push down before pulling back, and again we have the 1, 2, 3 right in the beginning. We have a 25 to 50 pip stop hunt right at the beginning of this session, and then another 50 pip move back down to the open. So again, plenty of movement here. We're going to talk more about that in some of the future videos about the open and how traders may be looking to capture some of that early momentum. Market stays sideways in that 50 pip range. Peak formation stop hunt just barely pips out traders and comes back down to the low inside of that 50 pip box. Gives us a bullpen hammer just prior to our 12 candle window. So again, a bias may form for traders to be long heading into this session. Again, not necessarily on the 15-minute, but again, a 25 pip stop hunt back to the high of the day, and then a stop hunt back into traders who are long before the London hour takes us back up 50 pips. Again, taking us up higher before the market consolidates. We get a bear pin hammer at double zeros for a 100 pip move back down to the low of the day. Forming a peak formation in the gap time. So again, understanding these are all timing specific. We get a peak formation triggering breakout traders at the low of the day. Getting other time frame traders in the market before consolidating, engulfing, and again, the little reversal, the 3-bar reversal, then the bear doji, and the first candle of our 12 candle window breaks out for a move back again through the high of the day. Who's in the money? Peak formation high, peak formation low, 12 candle window. reversal trade setup. This is a blow-off move, a vertical candle. They've triggered the previous day's lows, and again, the market pins it and then consolidates. It does not go through it. Prime evidence possibly that this market has now got other time frame traders short in the market. Hourly, 4-hour, end of day, and their stops most likely are at the high of the day. So again, triggering other time frame traders and then hitting the stops, going after traders who are in the money and going after traders who chase the move down late, low, before hitting the stops and reversing the market. The market goes up, forms a peak formation high, and then works down in 3 pushes again into the double zeros before engulfing and consolidating sideways at the quarter level above the double zero. It fails to break out of that box. And again, another opportunity for traders at the beginning of the session for a stop hunt back to the high of the previous day and the high of the U.S. session for traders who were short in the market, possibly holding on to this, hoping that it was going to reverse, but the stops get hit. Again, the market comes down 50 pips after moving up to the double zeros, consolidates, goes sideways, and then bang, back to the high in 3 pushes, 1 push, 2 push, 3 pushes, before pulling back and reversing for a 50 pip plus move back to the low of the day. In our gap time, we get a peak formation low. The market fails to follow through on the upside, working down in 1 push, 2 pushes, 3 pushes, pinning the low of the day again from the peak formation, and then giving us our engulfments and a move back through the high of the day. So again, timing window, peak formation, stop hunt, but we're inside of the high and low of the week. This was a stop hunt back into the low of the day, as well as traders who may have been long off the beginning of Asia. And then 3 pushes back into the low of the day. The pushes are down. We get a pin hammer and then an engulfment, a bull candle breakout candle. So the pushes are down. We're looking for the move back to the high of the day. Heading into the beginning of the week after Christmas, again, we get a breakout of a high of a day right off the bat, breakout pullback, and a strong continuation for a 100 pip move up. Again, we're going to talk more about these in future videos, but high and low of the day, we get the engulfment in Asia in the equities hour. At the last candle of the equities hour, it drops and goes into consolidation sideways at 50. So we're in the middle of a 100 pip box. The market breaks down and consolidates beneath the double zeros before breaking down and pinning well below the zeros again for a 25 pip stop hunt below the double zero box. Clearly now we're in a reversal situation. The market is working down. It pulls back a 25 pip stop hunt against the trend above 50 before breaking down and consolidating, stop hunting back into the numbers for the continuation back down in the gap time through the low of the day, but also pinning through, triggering the previous day's low, again triggering other time frame traders. This is 2 hours prior to our 12 candle window. Then the market in the hour prior pulls back and then works into the low, and on the last candle of the hour prior to the 12 candle window, we get our little bullpen reversal hammer in the peak formation at the end of the hour off of 50 just prior to our 12 candle window opening after 3 pushes down into the low. 1 push, 2 pushes, 3 pushes into the low for the stop hunt back up for 100 plus pips. So again, nobody gets a free lunch. Who is in the money? Where are the stops? Which traders have been holding on or are in a big move? Which traders got in late? Who's chasing this move down? Where are their stops? Those stops are money. And I'll just zoom in on this if I can. These traders who are in these trades have stops either at break even. I'll get this out of here. Just zoom in on this a little bit more. Get this opened up. Maybe not. Okay, there we go. So again, these traders may be at break even, but the market's going to ensure that they get nothing or they get stopped out with a loss. So again, anybody who keeps following us down lower, you got 3 lower levels of stops. And when this market comes back, it forms our shortened W right at the beginning of the 12 candle window. And again, it's just timing window. If you miss something coming down, you think you've missed this huge move down, you've got to be reminding yourself, nobody gets a free lunch. Who's in the money? Even for a 50 pip move, this market would easily come back for a minimum of 50 pips, which is nothing for this market, whereas it's come clearly at least 250 from the low. Again, we see the market pull back and consolidate inside of a 00 range on the Friday before pinning up in the beginning of the session. We have a high and a low of the day. It's important to wait. I would rather take one good trade all day long where it's easy and no stress off the high and the low of the day than try to trade all this stuff inside and get caught and be sitting in something for hours on end. I'm waiting for them to hit the stops. And this market, without a doubt, never disappoints because nobody gets a free lunch. They eventually break out and reverse in the U.S. session, but there was 25 to 50 pip trades off the high and the low, even in a tight consolidated 50 pip range. We come to the market again just after Christmas into the New Year, prior to New Year's, and again this market just continues to move in 50 pip, 75 pip, 100 pip ranges. Again, the market moves up and extends outside of our 12 candle window before locking in our M formation and reversing off of 50 for a stop hunt back down to the low of the day. We head into our 12 candle London window, and the market stays consolidated in that quarter range underneath. Think squeeze. When the market's pushing down in a level and not going anywhere, think squeeze. So you're either going to get something in the gap time, or you're going to get it when? In the next 12 candle window. We get a pin hammer to the low of the day before we get our engulfment. The market comes back to the high of the day, reverses for a reversal into the traders that have gone long off the engulfment before continuing back up through the high of the day and trending for the rest of the session. So again, opportunities on lower time frames when these stops get hit. We'll talk more about that in the future videos. And again, big moves every day, pretty much. Although it was December, a lot of traders were concerned about trading these days. As I said, I was trading them as normal as any other day. The market gives us an M formation in Asia for well over 50 pips down. Works the low in 3, pushes in the gap time, puts a peak formation low in. And then at the end of our 12 candle, our gap time heading into our 12 candle window, we get a bull pin hammer and an engulfment 3-bar reversal heading into our 12 candle window. We want to be trading off the low on the third push back in line towards the high of the day and asking ourselves which traders are in the money, where are their stops, who they're going to go after, who got caught down low. These lower highs are just telltale signs of a minimum opportunity for a minimum stop hunt right off the bat at the open of the session. And again, once we're inside, knowing that we can get a stop hunt back to the high of the day at the beginning of the U.S. session, but also knowing that when you get these higher lows, important again, learning to take a profit, especially if you're the first mouse, because they are going to come back and either tap you out at break even or stop you out with a loss. My first move, I always pre-program. If I have multiple positions, that's different, but my first position, always I'm taking money off the table, whether that's at 25 or at the high or low of the day. Again, depending on where my fill price is, I am taking it off, pre-programmed off the table and looking for that second entry back either for the second 25 or 50 pips or for the reversal if this market indeed is offering a reversal trade. So again, as we head into today's session, we see the gap. That gap actually was just above a weekly high at 66 from 2 weeks ago. We see the market breakout, pullback, and continue. Again, last candle prior to our 12 candle window, we already had our engulfment, but the last candle of the second hour, the bull candle is a continuation move. We're trading back in line with the trend, and it's looking like we may have a high of the day being put in place, and this market may be coming back in our 12 candle window. We'll watch and see how it trades. for that move either back into the Asian traders who are in the money or back to the high of the day. Hopefully you got value from today's video, traders. Stay disciplined, stay focused, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.